The phone won't stop vibrating. Not once, not twice, but again and again, like someone on the other side of the world is trying to wake you up. You open one eye. The room is completely dark except for that quiet buzzing. At first, you assume it's just another trading alert, another meaningless notification from a market that never sleeps. But when you pick it up, something immediately feels different. You unlock the screen. Your Futures app is already open, and the first number you see makes your brain completely pause. Brent crude, up 9%. You sit up slightly, because commodities don't move like that without a reason. Not Brent, not at 3 a.m. You refresh the app. Your position appears, the one you opened 2 weeks ago. 12 Brent crude futures contracts. Entry, $74.40 per barrel. The profit updates, $207,000. For a moment, your mind refuses to accept it as real. You refresh again, $212,000. And then the notification appears, breaking news. You open it slowly. Conflict escalates near major Gulf shipping route. You stare at the headline, then back at the chart, then back at the headline, and the connection becomes clear. Oil isn't rising because of speculation. It's rising because somewhere in the world right now, in real harbors, real shipping lanes, on real vessels, something has gone terribly wrong. The chart refreshes again, 218,000, and a strange thought enters your mind. By sunrise, this trade might make you more money than you have ever seen in your life. But before the night ends, you'll face the exact decision that destroys most traders. You just don't know that yet. 2 weeks earlier, none of this existed yet. No headlines, no chaos, just quiet charts. Brent crude had been ranging sideways for months, between $78 and $85 a barrel. No breakout, no trend, just slow, invisible compression. Most traders ignore markets like this because nothing appears to happen. But sideways markets often hide pressure, like a spring coiling tighter every day, invisible until the moment it releases. And when it releases, it never does it gradually. 3 nights before the call, 1:17 a.m. Your apartment dark except for a spreadsheet. You are not a professional trader. You work in supply chain logistics during the day. But for 3 months, you have been reading things most people skip past. Tanker route data, OPEC Plus production reports, and EIA storage numbers. Not for excitement, because you believe you have found something the market is mispricing. Before we go deeper, remember the number on your phone 2 weeks from now. $218,000. All of it traces back to what you're about to learn at 1:17 a.m. Here is what you found. Crude oil trades in 2 major global benchmarks. Brent, the international standard, priced in London on the ICE exchange, used to price roughly 2/3 of the world's oil supply. And WTI, West Texas Intermediate, the U.S. benchmark, priced in Cushing, Oklahoma on NYME. They normally trade within a few dollars of each other, but when that gap, called the Brent-WTI spread, widens unusually, it signals something. The international market is under pressure that the U.S. domestic market isn't yet reflecting. And right now, that spread is the widest it has been in 14 months. You had also read about the Strait of Hormuz, a waterway just 34 miles wide at its narrowest point, through which 20% of the world's entire oil supply passes every single day. 1 in every 5 barrels that crosses an ocean goes through that corridor. And OPEC Plus, the cartel of major oil-producing nations, had just confirmed production cuts. 4 producers pulling 6.7 million barrels per day off the market, 6% of everything the world burns every day. Already gone from supply. You don't know it yet, but in 14 days, every single one of these facts will matter on the same night at the same hour. So your thesis was not complicated. If anything disrupts that corridor, anything, the market is not ready. Supply already constrained, inventories below 5-year averages, and Brent options pricing almost zero probability of a shock event. The risk premium? Basically nothing. That is the mispricing. So you built a position. 12 Brent crude futures contracts on ice, each contract 1,000 barrels. Entry $74.40 per barrel. Total oil exposure $892,000. Margin required around $71,000. Stop loss set at $68, below the last major support. You told your wife it was like an investment, which was accurate in the same way that chess is like checkers. She trusted you. You tried to deserve it. Back to 3:14 a.m. You are fully awake now. You move to the desk, open the full chart. Brent crude at 84.20. Your position? Up 207,000. You check the futures curve, the shape of oil prices across different delivery months, and you see something significant. The curve has flipped into steep backwardation. The nearest month contract is trading significantly above future months. In normal conditions, the curve slopes upward. You pay more for oil delivered later. Backwardation flips that. It means the market is saying, we need oil now, not next quarter. That is a supply disruption signal, not a rumor, a price structure. You refresh the chart. 85, 86. The speed is unlike normal trading hours. Here is the mechanism. Every trader who bet oil would fall, every short position, has a stop loss somewhere above. When price hits that level, their broker automatically buys them out. That forced buy pushes price higher, which hits the next short's stop loss, which triggers another forced buy, which pushes price higher still. It feeds itself. In a market already panicking, an algorithmic cascade can move price $5 in 3 minutes. Trading forums are lighting up, predictions everywhere. $90 oil, 100. Your phone fills with messages from people who have never mentioned Brent crude in their lives. The crowd is arriving, and crowds create momentum. But crowds also create something else, the conditions for a violent reversal. You set the phone face down. Your profit flashes, 250,000, and then the chart does something unexpected. For 3 seconds, the price feed freezes. The chart stops updating. Liquidity vanishes. Your heartbeat quickens, because you know what this means. At moments of maximum uncertainty, markets sometimes pause before their next move, and that next move can go either direction with equal violence. The chart refreshes. Oil jumps, 88, 89. Your profit, $260,000. That was the first time the market felt personal, not like a chart, not like a number, like something happening out there in the physical world, and you happened to be sitting at the exact intersection of the information and the instrument. It is a strange feeling, and it doesn't fully leave you. The VIX, the market's fear index, sometimes called the fear gauge, spikes above 35. That is not a normal reading. At 35, institutional risk managers reduce exposure. Insurance models go into crisis mode. Pension funds quietly hedge. This number is not abstract. It is a real-time measure of how frightened professional money is right now, and that fear is fueling your profit. Oil approaching $85. March resistance, a price level where rallies failed twice earlier this year. Technical traders worldwide are watching the same horizontal line. Algorithms are programmed to respond at it. At resistance in a panic move, there are usually only 2 outcomes. Price breaks through cleanly, or it rejects violently. There is rarely a middle option. But the news tab keeps updating. Shipping disruptions confirmed. Energy analysts revising supply forecasts upward. Routes that carry 2/3 of global crude are now under uncertainty. And then a message arrives from a contact in shipping logistics. You open it. Tankers rerouting, marine insurance premiums tripling. If this holds through tomorrow, Brent could see 100. You read it twice, because $100 oil means your position doubles. $500,000, maybe more. Your hand rests on the mouse, but it doesn't click. You step back from the desk, and here is the thought that arrives, the one that no trading course prepares you for. Every dollar on your screen right now exists because somewhere in the world something is going wrong. Real shipping crews rerouting, real fuel prices rising for real families, real supply chains fracturing in ways that affect people who have never heard of a futures contract. The money is real, and so is that. This feeling has a name in trading psychology. It's called crisis alpha, the premium that risk-taking generates precisely during periods of maximum uncertainty. It is legal. It is how markets function. Price discovery happens with or without your participation. But knowing the mechanical justification doesn't dissolve the weight of what you're feeling. And you decide that it probably shouldn't. A trader who feels nothing at this moment is not someone you want to become. You call your mentor, a woman who has traded crude oil futures since the late 90s, through the 1998 collapse, the 2008 spike to $147, the 2020 crash to negative prices, a day when oil futures briefly traded below zero. She picks up on the second ring. You tell her everything, the position, the size, the profit, the message about $100 oil, the feeling at the window. She listens to all of it, without interrupting once. Then she says three things. First, sleep deprivation impairs trading judgment exactly as much as alcohol does, more in some studies. Second, have a plan for every price level before it arrives, not while it's arriving. The decision must be made before the emotion. Third, and she pauses before this one, when everyone agrees on a direction, it is time to question the direction. You write the third one down on actual paper with a pen. You tape it above your monitors. The act of doing it, physically, matters. You return to the chart. Structure matters more than emotion. That sentence is easy to say, much harder to live at 4 a.m. with $250,000 moving in real time. But you focus on what you know. Brent crude has moved into the extreme outer range of its Bollinger Bands, a statistical measure of price boundaries. In normal conditions, price stays between the first and second standard deviation bands most of the time. When price reaches the third standard deviation, that is not momentum, that is panic. And panic, by definition, exhausts itself. Your confirmation signal, a 15-minute candle that closes below the 20-period simple moving average. Not one that touches it, not one that comes close, one that closes below it. That is the market, in the language of price structure, saying the panic buying is over, gravity is returning. And you wait. You watch the candle forming in real time. It has 8 minutes left, then 6, then 4. The candle closes, below the 20 SMA. You check it twice, the signal is there, and now 3 exit triggers have formed in sequence. Price at the $85 resistance level, volatility expanding, volume thinning at the top, and retail attention arriving, the crowd that comes late and leaves last. 3 signals. Your written plan says, begin scaling out. But then the market does something unexpected. Oil surges again. 87, 88. Your unrealized profit jumps $380,000. And for 1 second, one genuine second, your finger stops. Because canceling the sell order would be easy. 1 click. And if your shipping contact is right, if Brent reaches $100, this could be $500,000. The sticky note above your monitors stares back at you. When everyone agrees, question the direction. Everyone agrees right now. Your rules were written before the headlines, before the profit, before the exhaustion and the forum predictions and the message about $100 oil. And rules that only apply when they're comfortable are not rules, they are preferences. Your hand moves. The spike stalls. Volume dries up. Momentum fades, exactly as expected. You close the next 4 contracts, then the final 4. Just like that, the position disappears. Your account balance settles, $310,000. The chart keeps moving. Oil continues. The machine doesn't stop, but you are no longer part of it. You close the platform. For the first time in 2 weeks, the screens go dark. Morning arrives quietly, not dramatically, not with music. Sunlight replaces the glow of the charts, the way morning always does, slowly, indifferently, with no acknowledgement of what happened in the dark. Outside your window, the world looks completely normal. Cars moving, people walking, coffee shops opening their shutters. Nobody down there knows what happened on your screens last night. Nobody knows about Brent crude, or the Strait of Hormuz, or backwardation, or the VIX at 35. They are simply going to work. And somehow, that feels exactly right. The market is a layer of reality that most people never see. You are not sure whether knowing about it makes you lucky or just differently burdened. Your account shows $310,000. You already know what you are going to do. Not spend it, not post about it. You split it 4 ways. 1 portion back into trading capital, properly sized, properly risk managed, because this trade doesn't change your risk framework, it confirms it. 1 portion into long-term index investments, because trading is not a retirement plan. 1 portion into a cash reserve. And a small percentage, you haven't decided exactly how much yet, towards something that feels like the right response to having made money from a crisis. Here is the thing experienced traders understand that beginners rarely figure out. The money from this trade is not what this trade was about. What it was about was 3 months of reading nobody asked you to do, averaging down when everyone laughed, writing a plan before the emotion arrived, the sticky note, the phone call at 4 a.m., the moment you didn't add size when the crowd said $100. Those are the things that made the money. The $300,000 is just the evidence that they worked. Step onto the balcony. The air is cool, not cold, just cool. Somewhere far away, the events that moved oil markets last night are still unfolding, still real, still affecting people who will never see a Brent crude chart. Oil will keep moving. Traders will keep positioning. The machine continues whether you're in it or not. But your role in this particular trade, this thesis, these 2 weeks, is finished. Because the market didn't pay you for being right. It paid you for knowing when to leave. What would you have done?